and welcome to Getting Your Money's Worth. I'm Judith West, and this show focuses on value. Our guest today is Cassandra Toroian, founder of Bell Rock Capital and author of Don't Buy the Bull, which is coming out when?
Early January.
Early January 2010. Don't Buy the Bull. Okay, so what does that mean? Thanks for being on the show.
Sure.
What does that mean, don't buy the bull?
Well, it means don't buy the bull that some of these personal finance gurus are telling us. Certain myths out there floating around.
Right, and your book goes out of its way to dispel some of these myths.
That's right.
Okay, so this is a little hard for me. How's this? Don't buy the bull, okay? So let's get right to it. Is it a myth that this time it's different?
I think this time is different.
So you think that's a truism?
I think that's true. I think that
what we're talking about is there have been other economic debacles, there have been other economic crises, and and we're told this time shall pass.
Right.
Referring to the history.
Mm-hmm.
You're saying that you think it's different.
It's different.
Why, how so?
Well, we're living in a different world now. There are financial products out there that didn't exist back when we had the first depression.
I'm not so sure we should call them products, but that's another story. Yeah.
Well, products, investment strategies, leverage, ETFs certainly weren't around before. Right. And so all of that has created, hedge funds, all of that has created a very different market dynamic. So the same old rules, which I would call old economy rules, just can't apply anymore.
Right. So tell me, you say you want to debunk the myths that many, I think you use in your book, or not your book, but in your talking points, that many financial gurus have used. What makes your point of view different, Cassandra?
Well, I'm actually an investor. That's what I do for a living. I actually manage money for people, and I sit and watch every day of my life what's going on. I've been doing it for a long time, and I started out in life as an equity analyst, both on the buy side and the sell side. So I have a very different perspective than some of the other people out there. I'm not a personal finance person that's going to tell you to cut back on the number of times you go to Starbucks every week to save a couple dollars here and there.
But plenty of folks that were giving professional financial advice got blindsided themselves, and these are all folks that have had a very good record. Were you invested in the market during this last debacle?
We were invested, but we actually came out of the market quite a bit prior to the Olympics. I viewed the Olympics as sort of a pivotal moment in global economics.
Why the Olympics?
Well, because China was really going full steam ahead. We were invested very internationally for the years previous, and I decided that that was a time that I wanted to use to take money off the table. So yes, we had quite a bit of money sitting on the sidelines.
All right, let's talk about this. I think one of the myths that you say is something like don't believe, you call it a myth, to stay the course, to stay invested, that doesn't work anymore. So what you say actually flies in the face of the Oracle of Omaha, who, if you ask Warren Buffett, he says the best holding time is forever.
Right.
What is it that you think folks should do? And furthermore, with that same question, if you take it out, when do you get in?
Right. Well,
so let's take it one step at a time.
Sure. Well,
not to hold the course. What does that mean to you?
Well, first of all, everybody has their own financial life path, in my opinion, and yours is different than mine.
But in
your
situation
is different than mine.
But in general, can we agree, Cassandra, that it may be a different skew here or there, but it's pretty much a model off of how much you're going to have in equity and how much you're going to have in fixed income? Or real estate. I mean, there's only a few different components that you can have your money in, unless you want to talk about the mattress, which we're not going to talk about.
But it also but again, going back to the fact that we all have our own financial life path, everybody has their own feeling about money and their own risk aversion. So while I could say to you, well, everybody that's age 50 should have 50% stock and 50% bonds, that may not make sense for you because that's not how you feel about money. It makes you very nervous to put a lot of money into
that's an individual
stocks.
approach, but in general, but we're talking about some generalities here. In general, that probably is a mix that works for a lot of people, 50-50. But when you specifically say don't hold the course, are you talking about an asset class or are you talking about a particular stock?
I'm talking about an individual stock or investment.
Okay.
Okay? My belief is that because we're in a new world that consists of very volatile trading, because we have hedge funds that are involved that control so much of the flow of stock being sold and bought every day, that you cannot have a very long-term horizon. It's not worth it.
So what would you recommend for folks who hold stocks?
Well,
how often should they trade?
Well, it's not about trading. It's about recognizing when you buy something that you're buying it at a good value.
Okay.
And being very disciplined about selling it when it reaches your price
so
target.
So do you decide in advance what your price target is going to be? I decide in advance
what my price target is, and when it hits that, I sell.
Even if it's on fire, you still sell.
I do, because that discipline is what puts money in my pocket. And knowing that the world is different and the world is volatile, I believe I'll have an opportunity to get back involved in that situation. And if not, there's always another one.
But Cassandra, you have told us your background. You know this. You know something about stocks. You know how to analyze that. The average person doesn't. So some of that advice may work just fine for you, but the average person is either doing it blindly on his own or her own, or depending on somebody else to tell them when.
Right.
And there's a lot of mistakes made that way, and a lot of trading costs that run up.
Again, I believe that at the center of all this, people have to take responsibility for themselves, okay? And their personal financial life path.
All right, so let's go.
So you can't put things on autopilot.
Okay, fine, but so let's go to that. For people who want to take responsibility for themselves and don't know how to be a stock picker, you also debunk, or I don't know how you say it, but there's something that you say about index funds being a myth.
Right.
And I was surprised by that because I thought index funds were a very efficient, low-cost way for folks who don't know stocks to get diversification and simply ride the market. Maybe you call it autopilot, but ride what the market does.
Right. Well, if you rode the market and you bought in at the wrong month and you were in the last 10 years, you rode the market up and down and you made absolutely no money. See, the problem with an index fund is that it has to hold a piece of every sector within the market.
Or you can buy a particular sector of index.
Well, but an index fund, by definition, if you tell somebody to buy an index fund, they're going to go out and buy an S&P 500 index fund.
Yeah, or
generally, right? Okay. So for my clients, I want to make them money in any environment. So if I know that we're about to go into a debacle with real estate and banking, why would I want to be invested in those sectors? So my point is you should not be broadly invested. You should be invested in the areas of the economy that are going to do well for certain periods of time. And that changes. So you, again, have to be very conscious about what's going on. This business of autopilot, I don't care if you're a bus driver or if you're the CEO of a company. Everybody has to be aware of what they're doing for their investments because, frankly, we all have to worry about our retirement, and you can't put it on autopilot.
Certainly what's true is that people need to take more responsibility for themselves.
Exactly.
But I don't know how folks are going to do that. I'm not convinced. I mean, you don't like mutual funds.
No.
It seems like your philosophy about investing revolve around picking the right stocks.
No, it doesn't involve stocks. Again, you can use exchange-traded funds, which are very low cost, as opposed to a mutual fund.
That's a fund. Unlike a mutual fund. That's something that trades every day.
Correct. So it's again because.
What is the difference in exchange-traded funds and mutual funds?
Well, they're both baskets of stocks. And the exchange-traded fund is transparent, so I can see exactly what it holds
and you can trade
in real time.
Yeah.
In real time, I can trade it. In real time, I know what it owns, unlike a mutual fund.
Okay.
So I'm not saying that the average person needs to go out and individually pick stocks, but but they do have to read enough to know, boy, now's not the time to be investing in real estate. I'm not going to buy an exchange-traded fund in real estate.
In this country, many folks are in the market, and in equity mainly, because of their own 401ks,
Correct.
of their employment.
Right.
And those folks really, I think, are almost hostage.
That's right.
To the plan.
Unfortunately. Right.
To the plan.
Yes.
So what can they do?
Well, again, they have to, I've seen too many situations where people set their allocations in their 401k plan and then they never look at it again, or they never really look at it except for maybe once a year.
Yeah, I mean, I think that's probably true for many people,
right.
401k
well,
or not.
Right, and that's just, again, it goes back to taking personal responsibility and having an awareness.
Yeah.
So that when the market is down, or you feel like it's going to go down, you sell those mutual funds. You keep cash in your 401k.
But what I keep coming back to with you, Cassandra, is you say when it's down or when you feel it's going to go down. I don't get. I mean, I don't get how that person feels it or knows it. I just think that that the timing the market is a very dicey. I mean, God bless if you've had good luck with it. It's a very dicey philosophy.
Yeah, it's not about market timing, it's about protecting your assets.
But even getting out, if you got out in March of 2009 when the Dow Jones was 6,500, would you have gotten back in at 7,200? Would you have gotten back in at 88? Now it's 10,500. When would you have gotten back in?
Well,
how does the average person know that?
They should have gotten out in October.
Yeah, but you know.
As a lot of people were recommending that people do.
And
so again, if you were aware of what was going on around you, I always say your first loss is your best loss.
Right. Well,
okay?
I think Bernard Baruch said it before you,
right.
but you're correct.
So, but I think a lot of people have forgotten that philosophy. And again, there's always opportunity in the future, but in the kind of environment that we're still in, look what happened last week with Dubai.
Right.
There are these things that are coming out that were going to come out over many years. This is not a one-year debacle we're in. So again, people have to maintain an awareness.
I do want to ask you, though, and we only have a minute or so left. You also say something about it being a myth that this is going to take a lot longer than 5 years. It's going to take a long time for us to come out of this. So you think we're going to come out in a shorter period of time?
Well, I think that the stock market has. There's a
so
difference.
Far, right.
There's a difference between the stock market and the economy. Generally, the stock market.
They seem to be disconnected right now.
Well, no, not really. If you look at the last 30 recessions, generally the stock market bottoms when the economic news is its worst. And I think we would all say that probably March was when the news was at its worst as far as unemployment figures, as far, really things were quite bad. And that's when the market really did tank the worst. And since then, as the news has gotten better, so here we are, that philosophy and that theory still holds. So
as a summary, for folks that want to do the right thing for themselves and care about what is the single best tip you can give us?
Tell them to not do it on their own, to go out and find somebody to help them so that they can.
But you have to find the right somebody.
Well, you know, that depends, and I talk about that in the book, exactly how to find that right somebody, because everybody is a little bit different.
All right, so it's Cassandra Toroian, Don't Buy the Bull. Correct?
That's it.
Okay, thanks for being on the show.
Thanks for having me.
I'm Judith West. Let's watch Getting Your Money's Worth.